it's fascinating. Everything's happening at the same time. I think it might be worth mentioning a few other things. One thing which I haven't really noticed many people mention is that the People's Bank of China has said that they're no longer vetting, if you like, the export of gold. In other words, if you're going to take gold out of China, you would have to get the agreement of the People's Bank. In other words, you get them to sign a form saying that's all right. You take that to the customs officer, and they will then endorse it. In practice, until now, no gold basically left China except little bits going into Hong Kong for the jewelry trade, because there were always people, if you like, going from the mainland into Hong Kong, buying jewelry VAT-free, sales tax-free. And that was perfectly permitted. That was fine. But other than that, China's been Hotel California for gold. It goes in and never comes out. This is a big change. The SGE has now said that, yes, you don't need to ask us anymore if you want to export gold. And basically what this means is that you've got a free flow of gold between the mainland and Hong Kong. So this is extremely important because it's going to give the Hong Kong market huge physical liquidity, potentially, anyway. Going both ways. So that I think is important. Why are they doing this? I think the answer is quite simple. You go all the way back to, the early days of China embracing capitalism. The one thing they didn't really embrace was the idea of fiat currencies. They knew that fiat currencies always fail. So they decided from the outset to protect themselves against the failure of fiat currencies by secretly accumulating gold. We're not talking about the PBOC's own foreign exchange reserves. We're talking about off-balance sheet, if you like. What in other country would be described as going into wealth funds. Though in China's case, this was, according to, I think it's Article 3 of the regulations, this was distributed around various communist organizations, such as the People's Liberation Army, such as the youth wing of the Communist Party, and so on and so forth. So this is something that happened up until 2002. At the same time as this gold accumulation occurred, the ordinary citizen was not allowed to own gold at all. So there was no competition against the state in terms of it acquiring its gold. Then in 2002, the Shanghai Gold Exchange was opened and citizens were permitted to accumulate gold. And since then, they've taken delivery of over 28,000 tons. Nobody knows how much gold China really has, but I did some back-of-the-envelope type calculations, looking at various things like the foreign exchange flows, which also were the preserve of the People's Bank of China, looking at the supply into the market, both from mines, which was a massive expansion between 1983 and 2002, and also sellers, investment sellers, particularly from Switzerland into that big bear market. Also, there was the gold leasing activity, because this was the original carry trade. You leased bullion at 1%, and you sold it into the market, and you bought US treasuries, which were yielding, well, in the early days, 10% or more. So, this was a very, very powerful carry trade, and it was obviously encouraged by the Americans, who were really trying to just get gold out of the monetary system and replace it with their own fiat currency.
China's fixation on gold goes back a long way. From the earliest days of its market reforms, Beijing was already wary of paper currencies and started stockpiling bullion quietly, scattered across various state bodies rather than parked openly on the central bank's balance sheet. Ordinary citizens weren't even allowed to own gold until the Shanghai Gold Exchange opened in 2002. Since then, Chinese buyers have taken delivery of tens of thousands of tons. Nobody outside the system knows the real total. Estimates pieced together from mining output, import data, and old leasing records put the state's hidden holdings conservatively in the tens of thousands of tons.
So China, if you like, its policy goes way, way back. Now, they would have known that they would need, at some stage, to protect their currency, the renminbi or yuan, whatever you like to call it, from the eventual collapse of the West fiat currency system. Until that time, they play along with it. They do exactly the same thing as all the other nations in terms of using the central bank, PBOC, to expand credit in desired directions. So the result is that, yes, they've got the backing, if you like, of gold in there. We don't know how much. My estimate originally was about 20,000 tons. Since 2002, they've obviously acquired yet more gold. They had a similar policy with silver, so they've got huge silver reserves, which we don't know. We don't know the quantity. That's managed more, if you like, as an industrial metal rather than a precious metal. But undoubtedly, I mean, bear in mind that the last standard that China was on was a silver standard. So silver is still in there, if you like, very much with that in mind. So we're now getting to the stage where, if you like, the future of the fiat currency system, and particularly the dollar, which is the king rat, if you like, of fiat currencies, is obviously pretty limited. And you could see that the plans were being hurried up in the wake of Trump's Liberation Day, April the 2nd last year, when he got all these boards with tariffs and all the rest of it. The tariffs that he announced against China were, sort of pretty high. I can't remember the detail, but it was interesting that literally in the week after that, China started securing trade relations around Southeast Asia, the ASEAN nations, if you like. And President Xi had a whistle-stop tour around places like Malaysia, Indonesia, Vietnam, and so on and so forth, all in a week, obviously discussing how Southeast Asia was going to work as a free market area, if you like, and secure its future against a declining dollar. Because it was quite clear that these moves were anti-dollar. Not only that, but the dollar had been weaponized by Biden against Russia. So everybody knew that, you didn't really want to have dollars. Otherwise, you're under the thumb of the Americans. And so the whole thing hurried up. And we saw last year, China announced that they were opening vaults in gold vaults, new gold vaults, where gold will be swapped for yuan and vice versa in Hong Kong and also in Saudi Arabia. Now, so what's that all about? Well, the idea basically is that these vaults, and they're rumored to be others being planned, they will allow China to fix the yuan to gold. All they got to do is just say, this is the rate, that's it. You can exchange your yuan for gold. Initially, I thought this would probably be restricted to foreign trade, but my view is shifting, and I think it could well encompass the domestic market, if you like.
Things sped up after Washington's 2025 tariff shock and the freezing of Russian dollar assets. Both events that signaled holding dollars carried real political risk. Within days, Beijing was making the rounds across Southeast Asia, pitching Malaysia, Indonesia, and Vietnam on trade and payment alternatives. Since then, gold for yuan vaults have opened up in Hong Kong and Saudi Arabia, and regulators are reportedly considering a broader overhaul that would loosen the PBOC's control even further. The end goal is a yuan-denominated, physically backed pricing benchmark, nicknamed the Shanghai Fix, meant to compete with the dollar-based, largely paper-settled London gold price.
So that's what's behind it. Now, the other thing is that China, in its forward planning, because it realizes that gold is central to securing the value of the yuan, it also realizes that a collapse of the dollar basically means that the paper market in the West will collapse with it. Because these contracts, okay, they refer to gold, but actually the dollar contracts, they're not gold contracts at all. No gold is involved except as a last resort. So, she had to, having imported an awful lot of gold, and you've had this continual flow of gold from west to east, she now had to set up a market which would be central, if you like, to that region in particular, and also be accessible to anyone who uses the China's new international payments system, CIPS. So the whole thing it's a completely new market. It will replace the collapsing Western paper market. That is the idea, and this is why they're talking about increasing the vault capacity to 2,000 tons. They're talking about dedicated refining facilities in Shenzhen for this market, etc., etc., etc. All these things are just basically coming together now. And the speed at which the dollar is getting into difficulties looks like accelerating, because remember, China knows exactly what's going on in the Persian Gulf as, if you like, an ally. I don't mean a military ally, but an ally of Iran. They've all got an interest of getting America out of what they call West Asia. And that's going to happen. And you can see that America certainly has made a huge mistake attacking Iran. And Iran is basically destroying all the US bases within the region. So, China can see this, and it can see the consequences. It can see the consequences of the restriction of oil. Now, it has actually softened that blow quite a lot by reducing its own imports of oil. But it can see what's happening, and it can work out what the impact is going to be on US treasuries. So we had a situation back in about February, I think it was early February, where quietly the PBOC told Chinese banks, if you have US treasuries, don't get caught with too many of them. In other words, he was saying, sell your US treasuries. So this is a big, big signal. And then we've had this rapid development, if you like, of this new market. And I think what it all indicates is that China's assessment is that rising bond yields will end G7 currencies. It needs to protect itself against that as a matter of urgency. And this is why it's hurried everything up. And that's roughly where we are.
Most Western gold contracts are really dollar contracts dressed up in gold's name, paper promises that are rarely actually backed by metal. If confidence in the dollar ever cracks, that paper market cracks along with it. China's response has been to build a physically settled alternative from the ground up, expanding vault space, adding refining capacity in Shenzhen, and tying it all into CIPS, its cross-border payments network. It's less a trading venue and more a monetary backstop. Infrastructure built for a world where G7 paper claims on gold can no longer be taken at face value.
Insofar as they are fellow members of the ASEAN trade agreement. But I mean, obviously, we don't know what actually went on between the Chinese leader and the leaders of the various countries he visited. No more than I actually know how much gold China has got. We can just sort of join a few dots together and come to conclusions. But the conclusions are pretty obvious. I mean, it's all there. The one thing that was stillborn was that China very, very quickly after that April 2nd fiasco talked with South Korea and Japan to speed up the free market integration of their economies. And that was, if you like, something which was, in the early stages of negotiation. It hasn't really gone anywhere because, of course, the Americans lent on the Japanese and the South Koreans to tell them don't do business with China, or, the equivalent. So, so the answer to your question is we don't actually have the direct evidence, but what we do know is that he did visit those countries. And what would he have discussed? He would have discussed trade. And if you're discussing trade, then you discuss payments. Well, that's right. I mean, they're doing it for different reasons. I mean, Japan's doing it for a very simple reason, and that is that the Bank of Japan's policy of QE is basically run out of road. So they do need their domestic institutions to start buying the debt. And the new Japanese Prime Minister, sort of had the Liz Truss moment. For those of us not in, Britain, this was our very brief Prime Minister, Liz Truss, who came up with, if you like, a sort of reflation argument, sudden reflation. Sterling had a crisis, the gilt market had a crisis, and after a while, the Bank of England pension funds actually had a crisis as well. So it all had to be smoothed over and so on. But, the Japanese Prime Minister did exactly the same thing at a time when not only were bond yields and interest rates rising towards 1%. I mean, this is scary stuff. The problem that the Bank of Japan has is that not only does it own about 60%, 50 to 60% of all JGBs, but you've got a 240% debt to GDP, government debt to GDP in Japan. So a small rise in interest rates is catastrophic for government finances. And this is why the finance minister turned around and said to the pension funds, we would encourage you, including the big government pension fund, we would like you to buy more of our debt. But what that means, of course, is that they will have to sell other debt in order to do it. Some of the other G7 debts are getting, if you like, a bit closer in terms of yield to Japan's, because Japan's has risen. But there's still quite a gap, I think, between the US and US short term. You're looking at 4% or something like that. So there's still quite a big gap there. But, having the finance minister leaning on the pension funds, leaning, I guess, also on insurance companies, basically we're seeing the end of that carry trade, the yen carry trade. And it's going to be very difficult, I think, for the US to fund its liabilities. I think they're probably going to have to reintroduce QE. But this is not this isn't QE at 0% or anything. I mean, this is real cost. And, I rarely see absolutely no alternative to treasury yields rising along the yield curve. I mean, we're already looking like sort of running up to break out on the upside above 5% on the 10-year. Not there yet. I mean, the 10-year is 4.62 or something, but there's no doubt about it. That is the direction of travel. Of course, the other thing is that the consequences of the fiasco around the Straits of Hormuz will drive up prices big time, not just of energy and energy derivatives. And diesel is actually something that should really be hitting the headlines in the next few weeks, because the Ukrainians also took out some of Russia's capacity, and consequently Russia has stopped exporting diesel. I mean, we used to get 40% of our diesel from Russia in Europe. So, these things are bad. And, of course, fertilizers, sulfuric acid used in the refining of non-ferrous ores, and particularly, non-ferrous ores, which are basically 70% of the source of silver. So, there are huge, huge pressures for rising prices and complete lack of supply, which can only mean one thing, and that is that the Fed is just going to have to create the liquidity for people so that they can pay these higher prices. That's called inflation. But the problem is that you drive up interest rates, you push a huge deflationary effect on private sector debt. All the zombies start falling over. I mean, it's not a nice position at all.